Yes, real estate investors, we have made it past 2020 tax season. So now is the time for us to relax and not think about taxes anymore, right? Wrong! There is never an opportunity for us to relax and stop thinking about taxes because there's always more tax loopholes that we can take advantage of to pay the least amount in taxes so you can keep more money in your pockets and less out of Uncle Sam. So today in this video, I am going to talk about 3 different tax strategies that you can implement in your business today so that way you can legally pay less taxes. By the way, if you are new to watching any of my content, my name is Nikki Burns, and I help real estate investors to increase their cash flows by $120,000 per year and pay the least amount in taxes so they can buy more real estate and expand their investment portfolio. So the first tax strategy I want to talk about today is incorporating your business to an S corporation. Typically, when real estate investors get started, they either register their business as a sole proprietor, meaning that everything is in their business, everything is in their name, or they will register their business as an LLC. Now, as an LLC, you have the option to determine your tax classification, whether you want to be taxed as a sole proprietor, a partnership, meaning 2 or more individuals in the business, or a C Corp or an S Corp. So today I want to talk about incorporating from a single member LLC that's taxed as a sole proprietor to incorporating to an S corporation. So I've created this scenario here so I can write out everything and show you what the advantages are of incorporating to an S corporation as opposed to being classified as a single member LLC that's taxed as a sole proprietor. So let's say, for example, you are taxed as a sole proprietor in a single member LLC and you've earned $200,000 in revenues and you had $20,000 worth of operating expenses. And these are expenses that used to help your business operate as far as your rent, your utilities, your insurance, and anything like that to help keep your business afloat. So you had $20,000 in operating expenses from $200,000 in revenue that you made. That will leave you a taxable income of $180,000. And let's just say that you decided to pay yourself from that $180,000, you decided to pay yourself a $70,000 salary. So from that $180,000, if you deduct your $70,000 salary, that will leave you a new taxable income of $110,000. Now, you would think from a tax standpoint that you would only have to pay taxes on that $110,000, right? Nope. You have to pay taxes on the full $180,000. And let's just say for the sake of argument that you are in the 30% tax bracket. So 30% from the $180,000 is $54,000 in taxes. You have to pay Uncle Sam $54,000 in taxes. So there's your tax amount for the single member LLC that's taxed as a sole proprietor. Let's look at the advantages of being taxed as an S corporation. Same scenario, you have made $200,000 in revenues. You had $70,000 salary that you paid to yourself for your hard work, and you had $20,000 worth of operating expenses. That will leave you a taxable income in your S Corp business of $110,000. And let's say again, you're still in the 30% tax bracket. Then you would only owe the IRS $33,000 on that $110,000. Now remember, you as a single member LLC, taxed as a sole proprietor, you had to pay the IRS $54,000. But in the S corporation, you're only having to pay the IRS $33,000. So being taxed as an S corporation, you would have saved $21,000 being taxed as an S corporation, as opposed to overpaying the IRS $21,000 being taxed as a sole proprietor in your single member LLC. And the general rule is that when you want to incorporate your single member LLC to an S corporation. You want to do that when you have made $40,000 in net profits. So let's go back to that single member LLC scenario, being taxed as a sole proprietor. So you made $200,000 in revenues, and you had $20,000 worth of expenses, and you had to pay, that left you a taxable income of $180,000, and you had to pay $54,000 in taxes. So we take that $180,000 and minus the $54,000 in the taxes that you had to pay. That leaves you a total net profit of $126,000. But remember, you've paid yourself $70,000, so we also have to deduct your $70,000 salary. So deduct $70,000 from that $126,000, which will leave you a net profit of $56,000. So since your net profits is over that $40,000 general rule threshold, then you can incorporate your business to an S corp, so that way you can save that $21,000 that you overpaid being taxed as a single member LLC. Make sense? All right. So moving on to the second strategy that you can implement, and that is implementing a bookkeeping system. Now, why do you need a bookkeeping system? Well, the benefits of implementing a bookkeeping system is to organize all of your income and receipts, so that way you can be prepared for tax season. And it also helps you know where your business stands financially, so you will know how to plan your business. Well, can you buy more real estate? Or if you don't have enough cash flow in your business, well, where can we cut costs? What areas do we need to cut costs in? Where are we spending money unnecessarily? So that way we can increase our profits and increase our cash flow and be able to, buy additional real estate to expand our investment portfolio. So having a bookkeeping system will help you know how much cash you have on hand each and every month, especially if you're keeping up with your books. If you're not, then it's not going to help you to operate your business efficiently. It's just going to make it a little bit difficult for you to keep track of all that information. So moving on to the third tax strategy that you can implement, and that is maximizing your deductions. So there are millions of deductions that you can take advantage of. I'm going to focus on 5 deductions. Now, the first deduction that you can take advantage of is only applicable to a sole proprietor or a single member LLC being taxed as a sole proprietor. And that is the home office deduction. Now, if you are a corporation, whether you're a C corp or an S corp, in order for you to get a home office deduction or anything like that, you would generally have to have that in your operating agreement. There has to be some kind of agreement in your operating agreement that talks about how the business is going to reimburse you as the owner for any of your expenses that you've incurred, to continue to operate or work for the business. Now, with the home office deduction, how that works is you can only deduct a portion of your home that you are using for your business as a deduction on your tax return. And how you determine the calculation of determining how much of the percentage you're using of your home, you have to take the total square footage of your home and divide that by the total square footage of the room that you are using for your business. For example, let's say that the total square footage of your home is 2,000 square feet and you're only using 200 square feet for your home. You would take that 2,000, divide that by the 200 square feet, and that gives you 10%. So you can only deduct 10% of your total home expenses on your tax return. And that can include anything from utilities, rent or mortgage, renter's insurance or homeowner's insurance, or internet, etc. So the next deduction that you can take advantage of is depreciation. Now, the purpose of depreciation is to allocate the total cost of the assets that you have purchased for your property that's going to benefit you over time and for multiple years. You have to allocate that cost over those particular years of time, which we call the useful life, and to recuperate all of your money. So it doesn't give you the opportunity to deduct your total cost for a particular fixed asset. You have to, allocate that over time. So for example, let's say as a real estate investor, you had purchased a single family home that you want to rent to tenants. You purchased it for $500,000. Now, the useful life for residential real estate is 27 and a half years. So to calculate your depreciation, you would take the total cost, divide that by your useful life. So we would take the $500,000 and divide that by 27.5 years. That would give us a total annual depreciation of $18,182. So for the 27 and a half years, you can repeatedly deduct $18,182 off of your tax return every single year. So moving on to the next tax deduction, and that is your education and training. Education and training meaning any real estate courses that you take to help improve your skill set and to help you become a better real estate investor, you can deduct that off of your tax return. Now, the things that you cannot deduct off of your tax returns are trainings and education that is required for you to do your job. So as long as it's not required for you to do your job, you can deduct any education and training courses that you pay for to better yourself. So the next deduction is the retirement contributions. You have your traditional IRA, you have your Roth IRA, you have your simple IRA, you have your solo 401k, and there are multiple, retirement plans out there. There are many out there. I just wanted to focus on these four. So with the traditional IRA and the Roth IRA, the maximum that you can contribute to each of those accounts is $6,000. Now you can add an additional $1,000 to catch up on your contributions if you are 50 or older, which will be a maximum contribution of $7,000. So any contributions that you make into your retirement plans, you can deduct that from your tax return. So the maximum you can deduct from your tax return every year is $7,000 for the traditional IRA. Now, just to give you one tip, now you don't get a tax deduction for the Roth IRA because that's after tax. So it's not a pre-tax contribution or anything like that. However, you do get the tax benefit of being able to make withdrawals from your Roth IRA tax-free because you've already paid taxes on it. So moving on to the solo 401k. So the maximum that you can contribute to your 401k is $19,500. Plus an additional $6,500 to catch up if you are 50 years or older. Plus an additional 25% of your net earnings. That means after you've already paid taxes of your net earning, you can contribute an additional 25%, which will give you a grand total maximum contribution per year of $57,000. So for the simple IRA, the maximum contribution you can make is $13,500 plus an additional $3,000 if you're 50 or older to catch up. And moving on to the last tax deduction that you can take, and that's the operating expenses. Now, these are the expenses that are necessary for your business to operate, such as your rent, your mortgage, your utilities, your insurance for your property, any internet, telephone bills, advertising. Now, just to do a recap of the 3 different strategies that you can implement today to legally pay the least amount in taxes. The first one was to incorporate your business to an S corporation. So that way you can save more money, pay the least amount in taxes, keep more money in your pockets and out of Uncle Sam's. The second one was implementing a bookkeeping system so you can keep track of all your revenues and expenses for the entire year and help prepare you for, tax time when it comes around, and to help you to plan your business so you will know where you can spend money, where you can't spend money, and where you can, where you have to cut down costs and make adjustments. And the third one is to maximize your deductions. That's via home office deduction, your retirement plans, your operating expenses, your education and training, and depreciation. Now, if you found value in this video and you want to work with me one-on-one, then click that link below to schedule a free consultation with me, and I'll be happy to assist you and walk you through the process. So until then, I will see you guys on the next video. Bye-bye.